Good evening, ladies and gentlemen, and a warm welcome to the second edition of the Almas NSE webinar on FX and liquidity risk, a global perspective from a macroeconomic perspective. Thank you for taking time off to join us today. My name is Sriram Ramnarayan, and I'm your moderator for the evening. To begin with, let me first welcome Ravi Varanasi, the National Stock Exchange, to give his opening remarks. Ravi Varanasi is the Chief Business Officer of National Stock Exchange, heads the exchange initiatives, market structure, policy, and business development across all asset classes. Ravi is a known figure in the financial markets. May I request someone to go on mute, please? Thank you. Ravi is an extremely known figure in the financial markets and with over 2 decades of experience in NSE itself. Before I hand over to Ravi, may I request all the panelists to please go on mute, please? And Ravi, the stage is yours. Thank you.
Thanks for the introduction. Mr. Narayan, Rajeshwari, Sriram, Venkatesh, ladies and gentlemen. Good evening to all of you. I thank Almas for working with us to organize this webinar on FX and liquidity risk in global crisis. We are living through unprecedented times. Ever since China locked down the city of Wuhan in January, large chunks of world population have been shut at home. I don't think any of us have ever seen any parallel to this level of economic shutdown. The lockdowns have slowed down the spread of pandemic, but at a significant cost. Governments across the world are realizing the economic and social impact and are now trying to reopen the economies. While social distancing and other measures must be sustained for some more months, it is imperative that social and economic life is opened up and we all get the new normal. The impact on economies around the world has been enormous. According to an IMF forecast for 2020, global GDP is expected to shrink by almost 3%. US GDP is expected to shrink by about 5.9%, about 7.5%. IMF forecasts India GDP to grow by 1.9%, but there are other estimates which suggest degrowth for India. US and Western Europe have seen huge impact on employment that varies anywhere between 20% to 45%. Disruptions to global supply chain are estimated around 30%. So we are literally living in uncertain and times, and the gloom is all over the place. The poorest are the worst hit since they don't have anything to fall back on. The lockdowns could drive over 400 million people across the world to absolute poverty. The resultant hunger could permanently stunt children's growth. This could lead to far-reaching consequences. Advanced economies are faring a little better because they have reasonable firepower to sustain through the lockdowns. But employment figures are soaring in many countries. Efforts by governments and central banks in terms of transferring cash, sustaining employment through schemes like various governments are looking at the employment support systems. These are trying to reduce the pain, but the overall situation is no great. Bond markets in America are signaling a wave of defaults, especially in hospitality, raw materials, power making, utilities, etc. The scarring of labor market could last for years. Indian government and RBI have come out with series of policy interventions to ease the burden of economic lockdown and to stimulate the economy. A substantial part of the package is towards providing credit and liquidity support to individuals and businesses. Cash transfers and free grains to most vulnerable and needy come to around 1 lakh crore. Some structural reforms are also part of the package, particularly concerning agriculture and opening up of various sectors to private sector participation. The silver lining, obviously, is the agricultural performance. The procurement, the harvesting and procurement have been very, very good this year. Let's hope these measures will help mitigate the suffering. We got into this crisis with a relatively weak macroeconomic fundamentals. So obviously, there is very little elbow room. We will have to find innovative ways to tide over this crisis. Given the unprecedented scale of shock, funding markets are under stress. Government and central bank stepped in with wide-ranging measures to sustain the supply of credit to the economy and to support the financial markets. The interventions have been timely, including the significant injection of liquidity, but the plumbing needs to work smoothly, which is not apparent so far. In addition, there are unknowns in terms of when the pandemic will subdue, which will depend again on finding a medical solution in terms of drug and vaccine. More importantly, producing these in numbers that cater to the world population uh, in an equitable manner. So there's a huge challenge for all of us. No one has any clear sense of when and how this will unfold. This uncertainty will continue to pose significant challenges to the financial system. This calls for coordinated action to support well-functioning, resilient, and open markets. The focus will be on ability of financial institutions and markets to channel funds to the real economy, the ability of market participants to obtain appropriate funding, the ability of financial intermediaries to effectively manage liquidity risk, and the ability of market participants and the market infrastructure institutions to manage evolving counterparty risk, etc. Any missteps in these sensitive areas could lead to worsening of financial conditions, which in turn could impact the stability of financial system as a whole. I'll stop here. We have eminent speakers who are experts in areas which we are able to discuss. I'm eager to listen to their views and comments. I thank all of you for participating in this webinar. Over to Venkesh for setting the context for this webinar. Thank you.
Okay, thank you, Ravi. And thank you, Ravi, for two reasons. One, for associating with Almas on our conferences as well as webinar series. And knowledge is very close to both the organization. And NSE supporting has made our conference as well as webinar series big reachability. The theme of the webinar series is to be seen as thought leadership forum, where a fine mix of practical experienced people like Anand and domain knowledge peoples and economists across financial sector meets the topical challenges head on. This webinar will provide a drive for participants to catch the green offshoots and convert challenges into opportunities. This is a forum where industry leaders, including bankers, corporates, and regulators, participate. Issues are deliberated and opinions are formed through a series in person and digital conferences and webinars. I'm not talking only about the today's webinar. I would also like to share with you that we had already finished one webinar series and it is second one, and another 3 or 4 to come in. So the further objective of this webinar is to establish the need of financial markets today, in particular about forex and bond markets and government security. The hot topic which we have been discussing and deliberating from last few decades, that about the rupee being exported rupee market to London and Singapore compared to Mumbai. And there is a big, good deliberation. And our last conference, we discussed about that, how to bring that market to Mumbai. And it's a time where now it is an opportunity time for us to have this team and see how we can work out. And also, the RBI has already said that they are permitting the NDF markets, and even NSE is ready with many products. Whether it is Mumbai or Gandhinagar, ultimately the rupee should come back to where it rightly belongs. Rupees pricing or rupee strength, rupees liquidity, rupee products, these are all very close to our heart, and they're all very beneficial to the market participant. This should come to India. Therefore, there is a request to RBI government to constitute a committee of market and business experts for executions of the various committee reports, how it affects the markets, how it affects the economy. That is one of the theme very close to most of us in Almas. I will conclude by saying, before concluding, I would like to introduce today's moderator. He's a dear friend, C. Ram Narayan. He's from market. He started his career as a dealer in a leading bank, then moved to then Thomson Reuters. Now it is known as Refinitiv. He was a country head there, and more than that, he was a dealer himself, and he was well versed with the market. And we all have some common themes to give back the market and contribute the market. I will conclude by saying the time to have rupee market more strong, more strength, and self-reliance in determining the rupee value onshore rather than offshore. Over to Sri Ram.
Thank you, Biju. You've been very kind. It's my pleasure to be associated with this webinar and the series as well. Thank you very much. Before we start introducing the two stalwarts who are in the panel today, a couple of things. One is that Q&A session is open throughout the webinar. However, we will take the questions at the end of the webinar. We will keep a good time enough to ensure that questions are addressed. I can already see 18 questions already sitting up on the panel. So Anand and Rajeshwari, you're like already lined up. How we intend to structure this panel is as follows. Point number one, we'll be looking at the macroeconomic situation pre-COVID, where we are today and what is the situation that we have to handle, what is the depth and the gravity of the situation. Secondly, we look at it banking in a financial perspective, having looked at the economic macro overview. Third, we will go to looking at the policy actions announced by the government and the Reserve Bank and deliberate on them before deep diving into specific corporate related areas. And most of the questions are coming in from the corporates about their worries or interest rate, exchange, currency, etc. In the end, we'll come to the silver lining. What's the silver lining that we have with this entire story, and if we can throw what are the next steps? So that's the structure that we intend following in the next few minutes, so that we can give the Q&A session back to the audience at about 5 o'clock. Thank you very much. As I said, although both these panelists require no introduction, and I'm not saying this as a repetition statement, but as a matter of fact, honestly, but it will be my privilege to introduce and say a few words about Anand and Rajeshwari. Professor Anand Narayan, SPJMIR International Banking and Financial Markets expert. He was at Standard Chartered Bank for a long time, headed the South Asia and the ASEAN markets across all asset classes, FX, interest rates, derivatives, bonds, etc. He's on the board of several financial institutions. He's an eminent speaker, various industry events, and of course, a financial channel stalwart. So that's Anand, and welcome Anand. Thank you very much for joining us today. Next, we have a vibrant new age economist, if I may say so. If I take the liberty, Dr. Rajeshwari Sengupta, Professor of Economics at IGIDR, a master's and PhD from University of California, 2 previous degrees in economics, one from the famous Delhi School of Economics and the Presidency College at Calcutta. Rajeshwari has written and mastered a lot of articles and papers and white papers, and she's on the committee of many advisory board, and particularly she's been tracking the economic policy, emerging markets, more specific reference to India. And if one sees the internet, and one can get a huge perspective into the intricacies of Rajeshwari's research. Thank you, Rajeshwari, for joining us, and in particular, we look to you for the macroeconomic trilemma and the twin crisis of the balance sheets of the banking and the corporate one. Both of you, and thank you for coming in. I would first request Rajeshwari to throw some light to us based on her expertise, one, and her liking, which she has been vocal about, in terms of the impact of where were we pre-COVID? It's not just today's environment that we are tackling in terms of numbers or the financial crisis. Where were we before that? And what has happened to those numbers pre-COVID that has made an aggregate difference in today's world, and what's your perspective from economic perspective? Please go ahead, Rajnishwari. Stage is yours.
Thank you so much. I want to thank Almus and Sriram for inviting me on board, and it's an absolute honor to be on the same panel with a stalwart like Anand. And I look forward to the next 1 hour of a very interesting discussion. So, will the screen be shared along with the slideshow?
It is already done.
Okay, great.
It has been.
Okay, great. So then I'll just look at my own slides because I can't see the slides.
Ensuring, just 1 minute. I'm just ensuring
sure.
Share my slides. Hopefully, it's coming down. And someone in the panel tell me if you can see it, or
Sriram, I can't see the slideshow.
I have shared it. You go ahead. I'll try and share.
Can others see it?
They would be on mute.
No.
Okay, just a minute.
Sure.
Only 1 minute. Yeah, is that better?
Yes.
Thank you. Sorry for the.
Thank you so much. Yeah. So I'll just let you know when the slides have to be moved forward.
Sure.
Yeah. Okay. Okay. So in the opening talk that I want to give, I want to basically talk about what Sriram mentioned, which is what was the situation in the Indian economy before we got hit by this massive shock. And of course, that's very important because the preconditions will play a very important role in influencing how the pandemic is going to affect the economy and also in shaping the policy responses. So we are, of course, in the middle of a global pandemic, which is inflicting two kinds of shock, as is clear by now. One is a health shock and one is an economic shock. The different ways to contain the spread of the virus, including social distancing, a lockdown in whichever form, are something that has been adopted by almost all affected countries of the world. And as a result of that, it has triggered fears of a global recession because, ironically, the effective containment of the disease requires stopping the normal functions of the economy. So the more you end up succeeding in containing the disease in some way, the worse you are affecting the economy, because that's how the two are related. Now, all countries in the world will have to deal with the economic mess that this measures as well as the health shock are going to leave behind. But in this, of course, India is not unique. But what makes India unique, and Anand here, Sriram, we can go to the next slide. So what makes India unique is the situation that the economy was in before we got hit by the shock. So I have basically 5 main points on this. One is on the macroeconomic conditions prior to the outbreak. And as we all know that the GDP growth of the country was on a downward trajectory. GDP had slowed to as much as 4.5% in the quarter ending December 2019, which by the new GDP series was the lowest level since March 2013, out of which industry, which is basically mining, manufacturing, construction, grew by merely 0.15%. So that shows how bleak the scenario was. Out of the different drivers of GDP growth, one important one is private investment. Private investment has not only been stagnant in nominal values, it has actually been declining. When I look at the CMIE data on capex, what I see is that the average annual growth rate of outstanding investment projects was negative, and the growth rate for new project announcements was also negative. So in nominal values, the investment has actually been declining, which is quite severe. The second important driver is consumption demand. We have always felt confident that Indian economy is a consumption-driven economy, but for the first time in 4 decades, we saw that private consumption expenditure fell in 2017-18, and even in 2019-20, the consumption numbers were quite bad. Other than consumption, the other important driver is, of course, exports, which largely because of the global scenario have also not been doing very well from an Indian perspective. So turns out that most of the major drivers of growth have not been doing well by the time we got hit by the shock. In fact, we have been in a slowdown for a long period of time. And one important outcome of that has been that unemployment reached a 45-year high before we got hit by the COVID shock. Going on to the next slide, so this is overall macro picture of how the economy was before the crisis hit. If we drill a little bit deeper on the financial sector and the balance sheet crisis that has been plaguing the banking sector and the corporate sector over the last several years, one of the main reasons why investment has been slow. As we know, the private corporate sector has been struggling with the balance sheet stress for quite some time, as a result of which the banking sector has been overwhelmed with very high levels of non-performing assets. The numbers are well known. The non-performing asset as a share of total advances was 11%. Majority of this was public sector banks, and I'm not even going into restructured advances. And as a result of the balance sheet stress, what happened was that bank credit slowed down to an all-time low. So by December 2019, the year-on-year growth rate of non-food bank credit had fallen to less than 7%, which was the lowest in 6 decades. And along with that, growth of bank deposits has also been falling, another worrisome trend. So not only has the banking sector been in a trouble, and that's very serious for us because India is a bank-dominated economy, and to the extent the banking sector has not been extending credit, that affects all sections of the country. Now, while the banking sector was struggling with NPMS, the non-banking finance companies were kind of filling up the vacuum, and they had increased their lending significantly in the 2014 to 17 period. But that good run, so to speak, ended with the default of a very large NBFC, the ILFS, in September 2018, after which, of course, the NBFC started facing widespread credit crunch. The credit spreads went up, even for very highly rated NBFCs. And as a result, in 2019-20, the NBFC lending fell dramatically. So what essentially this means is the real economy got starved of credit, first from the banking sector and then from the NBFCs. So whatever credit growth was happening was essentially private sector banks lending to the retail sector. So there's a lot of increase in unsecured loans or consumer loans. But industrial credit was practically, there was nothing happening there. And with the fall of the NBFCs, large sections of the country got starved of credit. If you go to the next slide, Sriram. So I spoke about the macro picture and the a little bit more specific about the twin balance sheet crisis in the corporate and banking sector. Other than that, there are some structural vulnerabilities that India suffers from, which I think makes India unique when we are dealing with such a massive shock like the pandemic, and also different from many other developed countries with whom we are often comparing our policy responses. One is that India has a vast informal sector, which employs close to 90% of the workforce, if I take into account the migrant workers as well as the daily wage earners, and they contribute more than 40% of GDP. So that's a substantial section of the economy. And needless to say, as we're all witnessing now, that as a result of a pandemic, the informal sector is going to be disproportionately affected. Because to the extent the formal sector, the firms have not closed down yet. Employees like, for example, you and I still have jobs. We are still able to get salaries and spend. But the informal sector works on a daily demand basis. And to the extent we have withdrawn our non-essential expenditures, the survival of the informal sector becomes questionable. And that, of course, has become significantly worse with the migrant worker situation today. And it's worth noting that even before the pandemic hit us, the informal sector was suffering from 3 very big shocks. One was the demonetization of 2016. One was the implementation of the GST since 2017. And then the NBFC crisis in 2018, which affected credit supply. The second important point is households have been leveraged going into the current crisis. So while the corporate sector has been deleveraging as a result of the twin balance sheet crisis, the household sector has been increasing its leverage. And that is also worrisome as we go into the crisis, because as unemployment increases, the households will be really pressurized to repay the debt. And the third point, of course, is underdeveloped and inadequately funded public health system, which is really, really affecting us very badly right now. And the worse the public health system, the more we need to extend the lockdown. And the more we are extending the lockdown, the worse the economic effect. It's kind of really interconnected. And the last point I have on this is, Sriram, if you can go to the next slide, on preconditions, is other than the macroeconomic problems, the structural bottlenecks, another problem that, of course, we had going into the crisis is limited policy space. Fiscal deficit has already been pegged at 4.4% of GDP for 2019-20. And for 2020-21, the fiscal deficit will be even higher because the tax revenues are going to be facing significant shortfall. Disinvestment is going to suffer. So the fiscal space is definitely limited, and there are any estimates going around that center plus state fiscal deficit could cross 10% of GDP, which is a very high amount. Monetary policy transmission was already weak going into the crisis. Despite the Reserve Bank of India cutting the rate multiple times, we did not see any pickup in bank credit growth. And there was a lot of liquidity injection that was already done, and the RBI continues to do it. Again, there is not much effect happening. So monetary policy, so to speak, has reached its limits, if I can say that. And of course, financial sector, as I just said, is badly broken. And whatever policy is going to be announced will be dependent largely on the financial sector. And to the extent that sector is not working, there is again very limited policy elbow room. So if you can go to the next slide, Sriram. Yeah, so I think that's the end of my opening talk, where I just wanted to paint a picture of the situation that was in the economy before we got hit by the shock. And now, of course, with that baggage of limited policy space, macro problems, structural bottlenecks, now that we are being hit by this massive shock, we don't have a public health system to deal with it. Of course, the consequences are going to be quite severe, and I'll talk about it subsequently. Over to you, Sriram.
Thank you, Rajeshwari. Important points made there, and a good summary of an aggregation of the woes, if we may call it. And I'll come to one or two specific points that you mentioned later in terms of lack of ability or the mindset to spend. One, and two is the employment going away at a base level. But before that, can I invite Anand to share your views on two things, Anand? So I'll combine a couple of things. One is what Rajesh said is in terms of the financial market, your reactions or your perspective on that one. And after that, secondly, going in to the measures taken by the government. So if you could, all yours.
Thanks a lot, Sriram. Really appreciate this. And thank you again to Almas and to NSE. Lovely to be with all of you. Was a pleasure listening to your presentation, Rajeshwari. It's very rare that two economists or writers agree. In this case, I completely agree with everything that you said. I think it was very well put. In terms of impact on financial markets and what policymakers are doing, the reality, Sriram, is things aren't looking great. Equally, though, there are ways out. It's not as if this is the end of the world. There are ways in which we can come out, and we're waiting and hoping for those things to unfold. If I can just quickly summarize where I think our fundamentals were and where our fundamentals will probably end up after this or through this pandemic crisis. As Rajeshwari so nicely put it, our financial sector was already stressed even before COVID-19. She mentioned 9% as the official gross non-performing assets. I think across banks and non-bank finance companies, the real non-performing assets, if you took into account SMEs, Mudra, and the fact that NBFCs have not gone through a asset quality review, was probably closer to 11-12% of GDP. So it's already pretty high. Second, you have many sectors of the economy, power, real estate, telecom, airline and shipping, several sectors which are chronically stressed and not doing well. Third, as Rajeshwari mentioned, in terms of demographics, our biggest strength is supposed to be our demographics, the fact that we have good people. And yet, in terms of unemployment, and the periodic labor force survey, which brought out the data, showed some really stark data. Unemployment amongst the youth, in rural areas, 18 to 20%. These are terrible numbers. Women only contribute 17% of India's GDP. Again, a terrible statistic to run with, right? So we already had a pretty bad state to start with. And as a result, the government was already printing and spending quite a bit over the last 3 years, even before the pandemic hit us. So while official numbers of, fiscal deficit shows everything's great, if you add up the off-balance sheet and if you look through the accounting smoke screens, the actual fiscal deficit has been really, really large. In fact, I'll just throw some numbers. For FY19, the official fiscal deficit was supposed to be 5.9% of GDP. I think the actual fiscal deficit, center and state put together, was 7.8% of GDP. For FY20, I think that number goes to 9.6% of GDP, which is an enormous number, right? And by the way, RBI has been monetizing a lot of it through bond purchases, through transfers of surpluses, etc. So we've already been in a pretty poor shape as far as the economy is concerned, and we've been printing and spending to try and alleviate that. Now, what will happen through COVID-19 and where will we emerge? Again, not a good story. Okay, clearly there is a huge amount of humanitarian and economic distress. Businesses are in trouble. Humanitarian part, the fact that a lot of the workforce is informal, as Rajeshri mentioned, clearly is a problem. We're going to have deep distress. CMI says 13 crore people are already unemployed as things peak and as things stand. We've all heard the stories about the migrant workers, etc. Second, businesses are in trouble, especially micro, medium, and small enterprises are in deep trouble. Now, as a result of all that, you are going to see further stresses to an already wrecked banking and financial NBFC system, right? So what I said was possibly 11 to 12% of NPAs already could move up to 18 to 20% of NPAs through the pandemic. And these are enormous numbers. I cannot overemphasize how enormous these numbers are. Now, as a result of all this, given the amount of humanitarian economic distress, the government has no choice but to try and spend its way out. It already is going to run a huge fiscal deficit because our tax collections are dropping. On top of it, there will be calls for even more spending. And this is both at central and at state levels. What I mentioned as 9.6% of GDP of combined center plus state fiscal deficit could go up to 14% plus in this current fiscal year. Now, a lot of things are developing. We are guessing out here. We're reaching out in the dark. But I'm saying as things stand, I can see a case where the fiscal deficit goes to beyond 14%. These are terrible sets of numbers by any yardstick. And by the way, RBI will have no choice but to monetize a big chunk of this fiscal slippage. You cannot allow interest rates to rise. So we'll have to print and spend. And by the way, we are not the USA. Ravi made this fantastic presentation in the beginning where he talked of monetization and what the central banks globally were doing. USA prints a currency which everybody wants. We don't print a hard currency. Therefore, we have a problem. So our macroeconomics is looking terrible. Where is the light at the end of the tunnel? There is a way out. It's not the end of the world. Normally, when we are hit by a crisis, we then start doing all the right things and we then start doing all the reforms which are required. What is the reforms I am hoping to see? One is complete banking and financial sector reforms. We have to clean the NPAs. We have to recapitalize the banks and non-banks. I am hoping a bad bank comes in and takes out all the NPAs for a separate resolution. We then have to follow it up with some real deep reforms, PJ&I committee reforms, banking reforms, governance reforms, market reforms. So a cleansing of the financial sector, I think, would be a first critical point. Second, we've been kicking the can down the road on many, many sectoral issues which are simply not going away. Power, real estate, telecom. We have to solve these. We can't just be an ostrich and pretend these things will go away. They will not go away. They have to be addressed one way or the other. Third and most important, our problem for the last 10, 20 years is we are not creating jobs. If our biggest strength is our demographics and we are not able to create jobs for our people, how on earth are we going to get sustainable growth, right? So that entire cycle of jobs and output has to be created. I'm hoping with the Prime Minister's speech talking of reforms and land reforms, labor reforms, liquidity reforms, bringing in supply chains from China. I'm hoping all of that actually works out and we get jobs and output going forward. So just as in 1991, we were staring at the barrel of a gun and then we did all the right kind of reforms to set us on the path for sustainable growth. I'm hoping that 2020-21 can see the next 1991 and take us to the path of jobs and output. One last bit, along with jobs and output, I hope this pandemic pushes us all into going for healthcare, education, and nutrition. If there is anything we can give our kids, it's these three things. That will not assure them jobs, but at least it will give them the best fighting chance of tackling a world which is rapidly changing. I'll quickly come to financial markets, Sriram, and here is where I have to caution people. There is the first thing that economists or quasi-economists, I'm not a trained economist like Rajeshwari, I'm a quasi-economist. The first thing economists have to understand and acknowledge is that we cannot pretend that economics impacts financial markets directly. Likewise, we have to understand and acknowledge as market participants, financial markets are not reflections of the economy. The two are different. Trying to say economy is bad and therefore markets will suffer is fallacious. Likewise, saying that the markets are great, therefore the economy is great is also fallacious. And I'll tell you how these reconcile. Financial markets are determined by flows. You and I can talk about macros till the cows come home, but they do not determine flows. Take the equity markets, for instance. Before as Rajesh was mentioning, even before COVID-19, our economy was in bad shape. Yet our equity markets were doing extremely well. Here is a statistic. The last 6 years out to December, for the Nifty 50 stocks, the earnings growth was less than 4% per annum, compounded. The growth in Nifty itself was 11% per annum. So there was a huge wedge between the performance of Nifty and the actual earnings growth. Now, there are lots of reasons, only 15 stocks in Nifty and so on and so forth. But nevertheless, the overall numbers still work. And the reason is very straightforward. If people like you and me are putting in money through SIPs into equity markets will be supported. It doesn't matter what the underlying earnings are. It doesn't matter what the macroeconomics is. Likewise, when it comes to currency markets, it would be a fallacy to say the economy is crumbling and therefore the rupee has to crumble as well. It could well happen that the rupee has a tough time, but just to use the economy as an excuse for what could happen to markets is I think can be very, very fallacious. So anyway, here is my 2-bit prognosis on the quick markets on currency, for instance. Currency is going to go through, I think, a couple of phases. The first phase is, if I look at the actual flows, the real, hard, permanent flows going into the country, what are they? They are the current account situation, the current account balance. Alongside that, you have the capital flows, right? You have FDI, you have portfolio flows, and so on and so forth. The permanent flows I see as the current account and the foreign direct investment, and maybe foreign portfolio investments in equity alone. So these 3 components. For now, the current account turns to be a surplus, and for the wrong reasons, because imports will collapse. Of course, exports will also collapse, but imports will collapse. We are not importing electronics, we are not importing oil, and therefore the total exports comes down. It will also be hit by the fact that remittances will come down. The Gulf is not doing well, so your NRI remittances will come down. But on balance, current account will probably be balanced or maybe a small surplus. So that becomes a big positive in terms of flows. FDI is still looking good. In fact, all the money that Reliance is raising, all the money that came in last year through ArcelorMittal, etc., these FDI flows are continuing. So composite permanent flows are not looking bad for the rupee. So what is looking bad for the rupee? It's the capital flows. The fact that portfolio flows aren't coming in, and the fact that there is a huge overhang of unhedged foreign currency exposures in the country. If I take the numbers from 2014 on to now, I can count about $130 billion of additional positions which have been put on in this country, which are essentially short dollar positions, long rupee positions. Why have these positions been put on? These are exporters selling dollars in the forward market. These are people who have taken ECBs and not hedged. These are debt flows which have come in into portfolio flows into equity. These are NRE deposits which have been put in, which will be taken out eventually as dollars. There are many, and plus, of course, speculative long rupee positions. All this put together, there is an overhang of unhedged exposures in this country where people are short dollars, which they need to buy. So the way I see this panning out, Sriram, is the following. I think in the short run, given RBI is sitting on enormous amount of currency reserves, given the fact that our permanent flows are not looking bad, I think the rupee will probably stay within the range. It will depreciate slowly. It will depreciate along with the other currencies in the world, but we will continue to do better than other emerging markets because of the permanent flows looking better. On the medium to long term, though, I would be very, very worried. Remember, I told you that the government will have no choice but to print and spend a lot of money. Normally, when you print a lot of rupees, as we saw in 2010, 11, 12, 13, 2 things happen. Eventually, when the economy starts to recover again, there'll be a lot of rupees chasing a few items. So inflation could go up for specific items like proteins, food materials, eggs, oil, your milk, and so on and so forth. And your imports could go up. Unfortunately, we are terrible at producing goods for ourselves, which means every time there is consumer consumption demand which comes up, we start importing for electronics, we start importing for plastics, we start importing for fertilizers, gold, oil, all of that. So eventually, that imports might start to go up. So a year's time from now, I'd be very worried about where dollar is. So if I was in your shoes, I would be looking to buy protection against weakening of the rupee. I wouldn't be worried right now. I don't think anything happens for the next 2, 3, 6 months. But I would be worried about what could be the situation 1 year down the road, given the very, very severe situation of our macroeconomics. Last bit, and I'll stop it there, Sriram. While I give all this gyan about where dollar rupee could go, we all know that taking a view on dollar rupee or on interest rates or anything else is tossing a coin. If you're right 51% of the time, you're a genius, right? So normally the way in which you manage any kind of risk, whether it's currency rate risk, interest rate risk, you have to have a proper risk management framework. And this is true for your personal investments as well, into equity, debt, etc. So the biggest amount of time you have to spend is figuring out how do you want to optimize between return and the risk that you take. That will help you determine what percentage of your portfolio goes into what asset class. In your personal investments, it could be what goes into equity, debt, gold, real estate, etc., or foreign currency. If you're a CFO looking to hedge dollar rupee, depending on your risk and return profile, there are mathematical ways in which you can figure out what your hedge ratio ought to be that achieves whatever is the desired level of volatility that you want to solve for. So beyond this gyan of, I think dollar rupee is going up or I think dollar rupee is going down, which is after all tossing a coin, you have to have a proper risk management policy, which matters less about where you think the dollar rupee is going, more about what your risk appetite is and what your risk, your return versus risk preferences. I'll stop there, Sriram. It was a long harangue. Apologies.
Oh, thank you, Anand. In fact, very well explained. I don't know how you read into the mind of people attending this webinar. 4 questions were straight directed at what we actually spoke in terms of how do you manage the unhedged exporters, the unhedged exposure that's lying around in terms of dollar rupee. So those were those questions which have come along, and more importantly, what you said actually looks to change the mindset with respect to hedging it. You can't sit quiet and hope and a prayer. Think that the right side of the coin will be tossed in your favor. So thank you very much for that one, Anand. And sorry, Anand, I'm going to continue with you before I go back to Rajeshwari in terms of the measures taken recently, and there are various sides in which you can see and feel the elephant in the last few weeks. And I think 1.3 billion people in India have become base economists, if not more. So your reading of that.
Well, Sriram, if I go to jail, you're going to bail me out, okay? But here is my broad view on the measures. Look, I think both Rajeshri and I explained that the government has constraints. If you already have a fiscal situation which is very, very constrained, you don't have much room to actually spend, right? And that's, I think, been the worry that the government has been grappling with. So let's start with the fiscal measures first. Prime Minister Modi announced a 20 trillion rupee, 20 lakh crore program of financial support. Of that, only about 2 lakh crore, so let's say 1% of GDP, was the actual fiscal impact, which means the actual relief given is only about 2 lakh crores. The balance is essentially liquidity. Essentially, if you're struggling for your bottom line, here is a bit of money, 3 lakh crores given to SMEs, 30,000 crores given to NBFCs, plus an additional 45,000 crores to other routes to NBFCs, and so on and so forth. So it's a provision of liquidity rather than helping your bottom line. There's been very little P&L transfer. It's been largely debt which is being given out. Likewise, RBI's 8 lakh crores has been counted as part of that 20 lakh crores, which is essentially flooding of banking liquidity than anything else. So in terms of the actual size of the economic package, very little relief has actually come through for the system so far. And I think the reason is very straightforward. The government thinks it's constrained. Personally, and here I am, thankfully, I'm a professor who can give gyan sitting in my chair. I don't have to worry about 20,000, things which are going around in the system. But I'll still pontificate. If it had asked for my advice, if it was up to me, I would say we should spend more. I'm supposed to be an economist who's supposed to be a fiscal hawk, who says don't expend the fisc, right? And that's true. In the past, I have said keep fiscal deficit under control. This is going ridiculous because I don't like people hiding the fiscal deficit using these kind of funny math. So I've always said that. But when you're in a war, when you're in a situation where people are suffering, when businesses are suffering, when you don't know how you will survive and how many people will survive, in those conditions of war, you have to keep your textbooks aside. You have to figure out what is the minimum relief required for humanitarian relief, what is the minimum relief required for business relief. These are tough questions to resolve, but then you have to keep that money aside and provide it. I think the money required is far more than 2 lakh crores. crores. I think the money required is at least 4 or 6 lakh crores, 2 or 3% of GDP. So personally, I would have kept a larger number ready. Along with that, I would have a credible roadmap to explain to everybody, including to rating agencies, including to ourselves, including to people like you and me, how are we going to pay for this? It's true. I mean, there was an unfortunate choice of words, no free lunch and all that. It's absolutely true. We'll have to pay for it. When you are printing and spending today, and if you're printing and spending and not borrowing today, you're borrowing from the future. You're borrowing from your children. So how do you intend to get that money eventually is a path you have to define. And to me, the mantra is, how do you provide jobs and output 2 years from now? If you have a roadmap which says, I'm going to do the following steps, and therefore I will create jobs, and therefore that virtuous cycle of jobs and consumption and more jobs that will continue, is what you have to have a credible map. It has to go beyond slogans into something which is credible and people can see. By the way, here is a quick thing. China's debt to GDP ratio, is more than 2 times India's debt to GDP ratio. So we get very upset when we say, oh, there is too much of credit in the system. There is too much of money in the system. China runs more than twice our number in GDP percentage terms. How do they sustain it? Because they've created jobs and output. So they've borrowed money, they've created money, which has gone into factories and into jobs. Those jobs create demand, and that demand then sustains into more jobs and more output. Plus, they become the manufacturing capital of the world. So on the fiscal side, I would have spent more and then come up with a credible plan as to how you would pay for it with jobs and output. On the monetary side, I think the RBI is doing a great job. It's already doing a lot of the heavy lifting. A lot of people criticize the fact that, why is it that the RBI is cutting rates at a time? What is the use of RBI cutting rates right now when there's no demand? The answer is very straightforward. It's trying to give relief to the financial services ecosystem. If banks are in trouble, NBFCs are in trouble, you cannot have high interest rates. That's the only reason it's doing. So I think RBI is doing a good job. Government is kind of constrained, but I think it can do more in terms of spending. One thing which is falling between tables, Sriram, nobody is taking care of the credit in the system or the credit flow in the system. Today, banks have plenty of liquidity, 7 lakh crores of excess liquidity in the system. But stuffing banks with liquidity and saying lend is silly. I mean, the problem which is stopping banks from lending is credit risk appetite. It's not liquidity. There's plenty of liquidity, no problem in liquidity. If I don't have credit risk appetite, unlike the Fed, the central bank is not buying corporate debt. It's not backstopping credit flow into the system. Even the government is giving very small amount. 3 lakh crores sounds like a great number for SMEs, but it's a very tiny amount for our overall ecosystem. So nobody is standing up as the last lender of credit into the ecosystem, because of which there will be pressures in the system. So the only thing missing between RBI and the government is somebody has to stand up and say, I will backstop credit. Otherwise, I think RBI is doing a good job. The government could possibly do more, both in terms of giving relief right now and giving a roadmap to truth and how will you create jobs and output going forward.
Thank you. Thank you, Anand. That was very well put, and you covered a spectrum of points there. So, Rajeshwari, actually want to pick on 2 points that Anand said. One is the one specific issue about the MSMEs and the guarantee. I mean, we've read your papers, and you'd suggested in the committees and in the paper saying that there should be some form of financing or guaranteeing of the finance to the MSMEs. That's one. So what your views on that? Are you happy? Point one. But before that, just to pick on Anand's point in terms of the spending by the government, is there something called by the government? So is there something called we will do what it takes, with a printing machine in your hand, we will do what it takes to rectify this. What are your thoughts on implications, the good and the bad of doing it?
Sure. So I'll answer the second question later. I'll first take up the MSME because that's a bit more specific.
Sure.
So I think, and I will not use the slides. I think I can just talk like that. So, so as Anand pointed out, and I mentioned as well, that before the crisis, as we all could see, that there was a very high level of risk aversion in the banking sector because of the years of non-performing assets that they were dealing with. There was a capital shortage. There were disciplinary actions being taken against the banks. For example, the prompt corrective action framework banks had to follow. Senior bank officials were investigated. There has even been a case or 2 of arrests. Banks were forced to basically take cases to IBC, which became costly for them because they didn't really have a lot of capital to provide for all of the losses. So let's of reasons, there has been a very high level of risk aversion in the banking sector. And after that, because of the NBFC default and the Yes Bank fiasco, again, writing down of 81 bonds, there is a lot of risk aversion in the bond market as well. So a large chunk of the financial ecosystem, so to speak, if I just keep aside the equity market, they're operating on very heightened level of risk aversion. And that's a very bad spot to be in when you're hit by a pandemic and you rely on the financial sector to deliver credit to the last mile, so to speak. So now, the way I look at it, the banks are essentially doing two things. And I talk about banks because they are the majority financial intermediaries in India. They allocate capital and they bear risk. But currently, because of the all-round uncertainty, they are not able to assess the absolute amount of risk in the system because there is no way anyone can know how long the crisis is going to last, how long the pandemic is going to last, how long the lockdown repercussions is going to last. Right? So it's very difficult for a bank to do that basic function of assessing the risk. So the way I am looking at it and the way what I recommended in my writings as well is this is where the government needs to step in and not the RBI. The RBI is doing what it can by providing the moratorium, by providing working capital relaxations, etc., etc. But what the government needs to do is the government needs to do what the banks are not able to do, which is bear the risk or share in the bearing of the risk. And that is where the credit guarantee mechanism plays an extremely, extremely important role. This is something that has been tried in all over the developed world in some form or the other, and we need to do a whole lot more in giving credit guarantee to the banks and to the businesses as well. Now, the government has taken the step in the right direction, as we saw in the package that was being announced, that credit guarantees are being offered for loans to MSMEs, partial credit guarantee for NBFC loans, etc., etc. Now, the problem that I saw in the announcement was the design of the credit guarantee mechanism. Because, for example, for the 3 lakh crore loans that the government announced, the credit guarantee was 100%. Now, the moment you announce a 100% credit guarantee, you essentially are saying that the lender has no skin in the game. And the moment the lender has no skin in the game, as a bank, there is absolutely no reason to be judicious in scrutinizing the loan applications. I would be, in fact, quite aggressive in giving out the loans. In fact, I may actually choose to give out loans to businesses which are on the verge of default because they have a higher chance of getting the credit guarantee from the government as opposed to relatively healthier firms which are just on the verge of becoming unviable from viable. And that leads to adverse selection, that leads to moral hazard. And I think that's a very problematic design of a credit guarantee scheme, which needs to be revisited. So I think credit guarantee is a step in the right direction. We need to do this, but not 100% credit guarantee. It has to be a partial credit guarantee where the lender also has skin in the game. And then the government does the job of bearing the risk. And the banks do what they are good at, which is they decide which borrower will receive the credit guarantee. So they're allocating the capital. And that's how it should be done. And that's something that needs to be explored. And the second point I have also on this is, while the credit guarantee mechanisms have been announced, the devil lies in the details. So unless the detailed mechanics of the schemes are being announced in terms of what are the conditions, what are the timeline for submitting the claims, timeline for encashing the guarantee, given the risk aversion in the banking sector, it is unlikely the banks will embrace the scheme, even if it's 100% credit guarantee. So we are in actually a very peculiar scenario that while there's 100% credit guarantee, which would be very attractive for the lending community, given the risk aversion, unless the government spells out all the detailed mechanics of the scheme, it will be a non-starter because the banks really don't know what they are going to be signing up for unless the details have been spelled out. So that's my point on the specific issue of the credit guarantee and the MSME. On the larger point of financing and printing and spending, all of that, of course, that itself requires a full webinar in and of itself, given the depth and breadth of that topic. So I do see the point that Anand is coming from, that the government needs to spend more because we are in an unprecedented crisis. And typically all economic prescriptions would always be that you spend when you are in a recession. Unfortunately, in India, we spend all the time, irrespective of whether we are in a recession or not, which is basically why we are where we are today. We don't really understand the concept of having a fiscal surplus. We are always dealing with fiscal deficit for the longest of time. And that's, of course, a big problem. And that's something that needs to be thought about subsequently. Now is not the good time. Now, given that our backs are against the wall and the government needs to spend, it is, of course, very, very difficult because there is no room to spend. There is no room for financing the fiscal deficit. The government has already announced an extension of its borrowing and is borrowing almost 12 lakh crore, 13 lakh crore from the market, which is already pressurizing the bond yield significantly. And so I think the way to go about it is, and of course, I feel very, very uncomfortable to say the central bank needs to print money, because once you unleash that beast, it is very, very difficult to rein it back. And that's what makes me very, very uncomfortable. So I think perhaps the way to go about it is first to calculate how much money is actually needed in terms of a fiscal relief. So instead of going the backward way of saying that the central bank has money and has a printing press and should use it, I think we should go about it the other way around, saying that how much money the government really wants to spend on a fiscal relief, on a fiscal stimulus, how much money the government already has from a market borrowing, from foreign investors, etc. And then what is the shortfall that the government needs? And then, if at all the money has to be printed, then do it within the institution of what we already have called inflation targeting. Because my worry is whenever there is a crisis, the temptation to ignore rules and frameworks runs very high. And then we just use the crisis as an excuse to say we are going to apply discretion and we don't care about the credibility of institutions, which may not hurt us in the short run, but for the long run sustained recovery, that is very, very damaging. So I think we should remain in the rule-based framework that we have created, because that is extremely important for the credibility of the government as well as the Reserve Bank of India. And within that framework, to the extent possible, consider what are the options of printing money. Because what happens in India is once we start a policy, we never stop it. There's nothing called a temporary policy. It always becomes permanent. Schemes become permanent, policies become permanent. We never unwind things. Now think of a possibility where the printing press is being used, and that's it. That's basically unleash the beast. So there has to be significant institutional checks and balances before you resort to that option. The developed world has the luxury to do it because US has a reserve currency, Europe has a current account surplus. They have the kind of credibility in the market that India does not enjoy. So if we want to go the same route, then I think significant amount of checks and balances and precaution has to be applied. So I feel very uncomfortable. I know there is no correct solution, but if we really want to do it, we have to do it within that institution of inflation targeting so that at least that credibility can be maintained. Otherwise, all hell can break loose. And we have been there, done that pre-1990s. We have enough precedents to show what kind of dangers it can lead to. And once we go down, so essentially you are injecting demand in a supply constrained economy. And there's bound to be runaway inflation if you do that. And once there's runaway inflation in a country like India, it becomes very, very difficult to control it. So we may now enjoy the benefits of low inflation, oil prices are low, etc., etc. But once you hit a double-digit inflation, even close to it, and the rupee starts depreciating, it is very, very difficult to hold it back then. So we should really think and make our homework before embarking on that path. That's all I have to say.
Thank you, Rajeshwari. I think that was a brilliant insight into a general tendency to say we should do what it can, and I think you pointed out the framework and the restrictions that need to be in place to avoid a catastrophe. Thank you very much. There is one statement that actually catches my attention. This was the Financial Times last week, saying disruptors will grab a larger share of the pie from the disrupted. That clearly demarcates the industries and the corporates which are have been affected due to one or two reasons, and then the new disruptors which will come up with a new leaf, a new business, either the existing players or new ones. So, Anand, more specifically to you, we find this to be, in my view, a really, really risk-averse, highly liquid financial system. There is lots of money, there is lots of demand, and then there is lots of pull in order to not let go because of these reasons, etc. So for a corporate to for a successful restart for a corporate, keeping all these things in mind, what would be your advice, guidance, or view in terms of a successful corporate restart? But before you answer that, Anand, I just want to mention one thing to the audience and the participants. Thank you for lots of questions going in. If you could point out as to whom your questions are addressed, that will make my job easier so that I could point out right to Anand or to Rajeshwari. Thank you very much. Anand, over to you.
So it's a great question, Sriram, and frankly, I don't think I can answer this in a short period, and neither am I the expert on this. Very broadly, I would think of it the following way. Look, changes have been going on even before COVID-19. The fact that technology is driving change, the fact that automation, machine learning, AI, artificial intelligence is changing the way in which businesses happen. 20 years ago, telecom companies used to make the most amount of money from SMSs. Then a WhatsApp moment happened, as Nandan Nilenkani's that lovely speech of his where he talks about it. WhatsApp moment happened for telecom, and suddenly SMSs stopped becoming a source of money. In fact, he's been calling for a WhatsApp moment for banking for the longest time. I think it will happen. I think banking will become history in the way we know it. So every business, irrespective of which manufacturing business or services you're in, is subject to change because of all these humongous changes happening on the technology side. I think COVID-19 is going to hasten this. The way in which we interact, the way in which we buy, the way in which we sell, all of that is changing already. Work from home is going to become a bigger norm, even after COVID-19, I think more ways than one. So here is the problem of these kind of dramatic changes. I think it's, if you and I knew, Sriram, as to what change is going to look like in 3 years from now, we would not be in this webinar. We would be out minting money somewhere. Because if you can predict and if you can put your finger on what it's going to look like, that's the next big thing. But here is the point. I think disruption is on the way. And can you imagine what it is like for the policymakers in this country? I kept talking about jobs and output. How do you get jobs and output at a time when there is so much of technology changes coming through, which is making jobs redundant? And now you have this entire geopolitical situation, which is globalization drawing back into localization. How on earth do you provide jobs for 1 million jobs a month that apparently that we require as a country? Right? So these are tremendous challenges. These are not easy to answer. Now, what I would suggest is the following. One is right now in times like this, unfortunately, and I would love as an economist or a quasi-economist to say, please go and spend, because that puts up GDP and all of that. But the rational response would be to conserve cash, be nimble, at the moment staying liquid, staying afloat, keeping cash with you. I don't want to take names, but the largest corporates in this country, the best performing corporates, are conserving cash. They're raising as much cash as they can, either through equity or debt or cost cuts, but they're raising and keeping cash, right? So staying liquid is going to be important. Staying afloat is going to be important. At the same time, you have to think about how your business is going to change. Look at Reliance, and again, I hate to take individual names, but they're moving from a complete petrochemical complex into this huge software e-commerce giant, right? It's such a huge pivot. And clearly they're making their bets about how life is going to be in 20 years from now. So I think it's a huge management challenge. All I would suggest is you have to do both. You have to think about the short term and preserve and stay afloat. At the same time, worry intensely about what 3 years, 5 years is going to look like. Chances are lots of businesses are going to get disrupted. Lots of ways of doing business are going to get disrupted. And as you rightly said, Sriram, those who can guess what new businesses will look like will obviously reap huge benefits. I'm sure you saw that slide, Sriram, where there was this 10-year gap between this New York parade, where I think 1906 this parade was full of horses and one car, and in 1916 it was full of cars and one horse. So the whole landscape had changed completely. I think we're on the cusp of that over the next 10, 15, 20 years. One last bit, we tend to overestimate change in the short run, but we completely tend to underestimate change in the long run. I forget whose law that is. It's a nice academic law, but I think that's absolutely true. So a lot of gyan for a simple question.
Thank you. Thank you, Anand. That was well said. It has context to some of the questions that are coming up, but I do want to give time for questions, and therefore one last question to both of you is as follows. I'll go to Rajeshwari first. If you were in the hot seat, either in economics in GT Aayog or the biggest planning body in economics or in the government, what would that one thing be that you would like to achieve? It would be foolish of me to say overnight, because these things really would get done. But for the sake of convenience, I'll say what would be the immediate term that you would like to implement and sign off.
Well, that's, of course, it's an extremely difficult, if not impossible, question to answer. I almost feel like calling Santa Claus for distributing candies, and then you just pick what candies you want because the laundry list is so long. But if I may just couch my answer in this context of what I really like is called the theory of creative destruction, which was propounded by a very famous economist called Schumpeter. centuries ago. So the theory essentially says that when there is a massive shock, and I'm of course simplifying it massively, that when there is such a big shock and you see large scale bankruptcies and firms are dying and many firms will go out of business, there is also a silver lining there, because there are firms which have very deep financial pockets, as Anand said, which are conserving cash right now, which were deleveraging before the crisis. So they're in a relatively stronger position. And they will be in a position to gain market share as many other firms go out of business. Because there will be a release of pent up demand that happens once we go out of the bottom of the crisis. And so many of these firms will be able to grab market share, and they may actually become even more profitable than before, and new firms will come up. And there'll be a complete change and transformation in the way businesses happen, because what we are witnessing today is unprecedented. So once we come out of that, and once the creative destruction takes place, then all of the other problems about creating jobs, about generating output, automatically sort of falls in place, because there are now these better, healthier, stronger firms which have withstood a recession, thereby that actually makes it stronger. And there's theories about that as well. And they are then operating in the landscape. And given the private sector is the biggest job creator, that takes care of the demographic dividend, the jobs, etc., etc. Of course, that's a very, very simplified thing. Now, coming to your question, for that to happen, if there was one thing that is really, really needed, I think, is for the financial sector to work. Because I think the finance is the backbone of every business. Until the time we get the financial sector to work, this entire process of creative destruction is not going to happen. Of course, there are many other things that are needed for supporting, like structural reforms, which have been pending for decades, like land, labor, etc., etc. I'm not even going into that. But one thing that we are seeing, and that is the immediate crisis, is the financial sector. And so, if I had any capacity, any power at all, basically figure out ways how you can get the financial sector to work. I think that would be very, very important.
Thank you. Over to you, Anand.
Very well said, Rajeshwari. So I'm going to be greedy. Since you've given me one wish, my first wish is going to be I want 4 wishes. So here are my 4 wishes. First is...
That's cheating. That's just cheating.
So the first wish would be, as Rajeshwari said, cleaning up the financial sector. How would I do that? First, I would create a bad bank to quarantine a big chunk of the NPAs. Second, I would undertake huge banking reforms, such as the PJNI committee reforms, which effectively takes babus and netas out of banking, gives it to professional bankers, and says this is not privatization. Third, I would do governance and market reforms to strengthen the financial sector. Once the financial sector is strong, it can support growth. We can go into a nice growth cycle. Second wish, I would do a cleaning of many sectors which are stressed, like I mentioned. So power sector, real estate sector, telecom sector, airline and shipping. These are chronically stressed. We are closing our eyes and assuming that these will go away. They will not go away. Closing your eyes will stop us from panicking, but it doesn't stop the train wreck. So I would absolutely reform those sectors. Third, as I said, jobs and output. How do you do that? You have to do deep reforms, 1991 type reforms, land reforms, labor reforms. Get the damn supply chains and make for India, if not make in India, even if exports is not possible, at least make for your own consumption. Get the people here, eat grass if you have to eat grass, but get jobs created in India. Okay? The last bit, again, what I mentioned earlier, I would invest in our children. Education, healthcare, and nutrition. Okay, this is something we've neglected. But if we think people are our best resources, give them all of this. Our children will grow up and they will figure out how to handle the future. These 4 things I would do. Once I have this in place as the broad framework as to how we're going to go forward, I think handling the present becomes a lot easier.
Can I just add one point, since Anand cheated and did 4 wishes?
Go ahead.
No. I think that one wish, of course, I said the financial sector. But I think what is really important is, I think we should use this whole crisis as a wake up call. I think we're all realizing that there are many things which are not working in the economy, and we have realized it for the last several years. There are many committee reports that have been written, but nothing is really implemented. I think one thing that's extremely important, and I cannot harp it anymore, is it's institutions. We really need to build strong institutions, and we need to sustain the strength and credibility of the institutions. Be it on the fiscal side, right? We have an FRBM, which is practically a joke. Nobody really listens to an FRBM act. It's just like a facade. We have inflation targeting, which was done in 2016, but for all practical purposes, now we are really not operating within that framework. And if I just go ahead from fiscal and monetary, if you look at any other structural institutions, call it judiciary, call it health, etc., there is an institutional crisis in India that I think we are all realizing now. And we need to really figure out that if we were to again get hit by another shock like this 50 years from today, do we really want to be in this situation again? And what do we need to really get done in order to not face this kind of a crisis? So I think their institutions play a very, very important role. Thanks, Vika.
Thank you. Anand and Rajeshwari, I think you really gave a passionate, huge coverage to what, and I got more than what I wanted. So thank you so much, and so is the audience. So we'll quickly jump to questions because we have 5 minutes. We may extend by another couple of minutes later. But and then the first question goes to you. I'm trying to combine the questions a bit. Believe you me, these are coming from people in well-known banks and the biggest corporates. The question is as follows. I don't want to change the texture of the question. I'm going to read it out therefore. What steps should MSME take to manage forex risk in this situation? MSMEs do not have the capability to take losses. MSMEs do not have the losses, do not have the capability to take losses now. It can't be more direct than this. So I know you already mentioned about risk management. So if you would like to reiterate or something.
I'll try and give this. There is something called efficient frontier. Okay, now that's very big word, so let's keep the jargon aside. Here is the deal in handling any kind of risk, whether it is equity risk, interest rate risk, or currency risk, right? There is a question of return, right? Can I maximize, if I'm an exporter, can I maximize my value for $? If I'm an importer, can I minimize my cost? So that return is one axis. The second part is the volatility, which means quarter and quarter, what mark to markets or what kind of results do I actually see? Okay. Now here is the deal. Any moving animal, if you take, whether it's equity markets, currency markets, commodity markets, the two, you can never optimize and maximize the two. You can never have minimum volatility and maximum return. That's a simple logic. Everybody understands this. There's also a mathematical rule which allows you to reduce volatility the most. Okay. Now, what that means is there is a certain golden percentage of hedge ratio, which typically, by the way, ranges between 35 and 65% for most commodities. If you achieve that particular hedge ratio and you keep maintaining that within that range, your volatility on quarter basis comes down the most. Now, if you say, I want no volatility at all, which is what the question seems to be seem to be about, I have a very simple solution. Please take sannyas, go to the Himalayas, stand upside out there and do tapas. No risk to come up currency markets, equity markets. If you're sitting here and operating, I'm sorry, you have to live with risk. There is no way you can minimize zeroize risk. You can minimize it by choosing an optimal hedging ratio, which depends on the asset class. By the way, for $, as I mentioned, 35 to 65% hedge ratio tends to minimize the volatility on a quarter-on-quarter basis. If you choose that, you will not maximize your gain. If, for instance, $rupee goes beyond 80 and you've only hedged 35% or 50% of your imports, you will still see a loss, right? But so somebody will do better than you. Somebody who's either hedged 100% or not hedged at all will do better than you. But at that 35-65% hedge ratio, you will minimize your return. This is what risk management framework is all about. I personally don't follow a risk management framework, I have to be honest, because I'm a trader at heart. So I do take bets. And by the way, if I get it right 52% of the time, I'm very happy. Okay, I get it wrong lots of times as well. By the way, I've given a few views this time. If the views are right, remember me. If the views are wrong, this conversation never happens.
Thank you. Thank you very much. Very candid of you. Thank you. Rajeshwari, the next question is up to you. A simple question. What's the cost to the country or the financial system of holding $487 billion reserve?
Very good question, and I don't know the number from the top of my head. There was a point of time about 2010-11 where the cost was around, when you work out the cost, it came to about 2% of GDP. I believe now it's going to be higher. But if I may just qualify that, just because the cost is relatively high does not mean the central bank should not hold reserves. Because the reserves today have become a signal of your strength and your ability to withstand currency volatility. And in such crisis times, when the currency is bound to be highly volatile in the next few months, or quarters, or years even, the central bank reserves do help in ameliorating some of that pressure, especially when you have such a high unhedged currency exposure in your country. So the cost may be high, but then that's something that, in a way, it's almost like the way it happens. In economics, we say it, do what the Joneses are doing. So essentially, do what the neighbors are doing. So if you are in this kind of a situation when all your neighboring countries are holding FX reserves, there is no way that you can't hold high reserves, because all emerging market countries get viewed as a basket by investors. And when they flee from all the countries. So essentially, if today Indonesia, Brazil, etc., South Africa are holding reserves, we also have to hold reserves. There is no other way out.
Thank you. One question I leave it open for any of you to answer. Actually, how do we address the immediate supply side problem in the near term?
You want to take it, Archie?
Sure. The supply shock that we are facing, the supply disruptions, are essentially coming from four main points. So one is, of course, we have a supply disruption coming from the massive labor displacement due to the exodus of migrant workers from the urban and peri-urban areas to the native villages. The second supply shock is coming from the non-availability of financing for, let's say, the MSME industry and even for some bigger firms. The third supply shock is coming from problems of securing supply of raw materials because of transport issues, because of restrictions on international trade. And the fourth supply issue is coming from logistic-related challenges, because you're not able to transport finished goods and raw materials, you're not able to market, retail chains are closed, etc. So, of course, given the differential supply shock problem, the response has to be accordingly. There cannot be one size fit all response to deal with the supply side problem. On non-availability of financing, I think we've spoken enough. In my mind, the biggest thing that needs to be done is giving credit guarantee schemes, because the banks are in no position to give out credit without getting the assurance from the government that they will not be held responsible for giving out bad loans at this point of time, given the past history. Second way of dealing with the non-availability of financing is to recapitalize the banks. I think NPAs, as Anand correctly pointed out, is going to be a very, very high percentage in the next 1 year. And the government needs to recapitalize the banking system. Otherwise, the banks are in no position right now to deal with that amount of losses. And third is suspending IBC currently is perhaps not a great idea, because the more you suspend IBC, the more the system will get overwhelmed with cases when IBC opens up. And without IBC, the banks have absolutely no way to resolve these bad assets. And that has an effect on the financing, because then they'll be that much reluctant to offer financing if they don't know how to recover the bad assets. So non-availability of financing supply can be dealt with in these ways. In terms of exodus of migrant workers, well, again, that problem has already started, and there is no way to get them back right now. And the only way to do that would be at some point of time, essentially when the economy starts recovering even a little bit, I think wages would have to be increased to attract them back. That's the only way the demand and supply can adjust to the price mechanism, that higher wages will high enough for them to be feeling enticed enough to come back to the urban areas, despite all the trouble that they have faced. On securing raw materials and logistics, there is no other way than just to gradually relax the lockdown. And we need to have a very, very phased and heterogeneous response to the lockdown, very decentralized. Some places need a more lockdown than the others. We are already doing it. The government is already doing it, which is great. And we need to continue on that path. For example, a city like Bombay needs more lockdown than a city like Lucknow. And stuff like that needs to be put into place more and more. So, yeah.
Excellent. Thank you. The last question, in the interest of good order's sake, for keeping time, the last question, it says, it's to both, I leave it to you. Do you expect a V or a W or an L-shaped recovery, considering most of our needs are inelastic? That's a short question.
Is that me or is that for Anand?
It says, actually, seriously, it takes both your names. So I was just being diplomatic in saying anybody can answer.
No, Anand, please take it.
I'll take a stab and then Rajesh jump in and disagree with me violently. That will be fun.
Sure.
So we've got a nice alphabet soup to work with in terms of what the recovery will look like. We've seen P, we've seen U, we've seen L, we've seen the Nike swoosh, God knows what not, right? So we've seen all sorts of shapes being discussed. Personally, I think this will take a while to recover. This is a deep shock. It's tempting. It's tempting to think that we're talking about for instance, for this first quarter of this GDP FY21, people are talking about minus 30 to minus 40% down as far as growth is concerned. That's a huge shock for one quarter, right? Now it's tempting to think that it's one shock and then followed by there'll be a quick recovery. We'll all go out and start buying and stuff like that. The reason why I think that that might not pan out, even though I hope and pray it does, is the following. One is, of course, the nature of the underlying problem is a pandemic. So if you don't have a vaccine, if you don't have a medical solution, you're still going to be very cagey about going out and spending money the way you were before the pandemic, right? So going out to a movie, going out and watching IPL, going out and having a good time is, discretionary spending is going to take a long time to come back. That's one part of it. Second, in the case of India, as Rajeshwari mentioned, you've had a huge labor dislocation. You've had a lot of migrant laborers moving back to their respective cities. Do they actually come back? Some people think they will, some people think they won't. I don't know what the answer is, but that's going to be a big debate which has to be resolved. So even you might have this funny situation that, industrial states like Maharashtra, Gujarat, Tamil Nadu, etc., or Delhi area, etc., are actually short of labor, where there's a desperate shortage of labor. People aren't there enough to do the odds and ends jobs. Whereas in places like the normal suppliers of labor, like UP, Bihar, etc., or even the Northeast, you have a surfeit of labor, where people don't have any jobs available. So you could see that situation pan out as well. The third part is, look, this is a deep, as both Rajeshri and I mentioned, this is a very weak economy which is taking a body blow. To expect that suddenly we'll stand up and start running again is I think, unreasonable. So I think it's fair to assume that this is going to take a long time to draw out. And and I think Dr. Montek Singh Ahluwalia was saying yesterday in a similar webinar that even if we get -5, or rather from -5% we shift to +5% the next year, it's still going to be a huge amount of output loss over the next 2 years. So it's going to be a deep gash for the economy now. Which is why I like what Rajeshri mentioned about be careful about how much you spend right now. It's tempting to say spend as much as you can. You have to be careful, bottom up, and only spend as much as is absolutely needed for keeping the animal alive. And keep the powder dry, because you might require it a little more going forward. And here is the other scary thing, Sriram. The only parallel we have to what we are going through right now is 100 years ago, the Spanish flu. And that went on for a good 2.5 years with 3 specific cycles coming through. Now, I hope and pray, and I'm praying to God this doesn't happen out here, that we don't have a second lockdown or second cycle, etc. coming up. But if you are a policy maker, you have to be prepared for all these things. So the point being that I think as a policy maker or as a business, as an economy, we have to be prepared for a slow, long drawn out. And therefore, your policies and your business decisions have to be based on that assumption. If we are wrong, great. If the market actually rebounds with a V shape, fantastic, but don't count on
it. So I just have a couple of points on that. So whenever I hear the L and the W and whatever it is, my first question to myself is recovery to what level? Because as I just pointed out at the beginning of this conversation, is that we have been slowing down for quite some time, right? If I look at the trend growth slowdown, there has been a trend GDP growth slowdown from 2011 onwards. So when we say recovery, I don't even know, are we recovering to the pre-COVID-19 level? Because that itself was again not very comfortable, because unemployment was high, investment was falling, and nothing really was working very well. Are we recovering to the pre-2008 level? That's not possible, because that was almost like an outlier scenario when everything was working well in the global economy. So recovery, that word itself needs to be redefined, I think, in terms of the Indian context, because what this shock is going to do is going to fundamentally change the global economic landscape. It's going to fundamentally change the way globalization, trade, foreign investment have been happening. And it's going to fundamentally change all our behavior in terms of how we operate in our businesses, in our consumption and daily life. So I think the word recovery is actually not even applicable at this point of time. It's going to take a very, very long time to even go back to a sort of stable situation where we are seeing a sustained sort of GDP growth at whatever level, a positive level, and with all the macro fundamentals in place and also jobs getting created. That's going to take a very, very long time. And I think having said that, what is really, really needed for that is reforms. I mean, once we come out of all of these things, it is imperative upon the government and the RBI to start doing structural reforms, because otherwise we'll have these short blips of a GDP growth, but we'll go back again, because India is in a very, very unfortunate position now where we are getting pummeled by shocks, right? I mean, as I sit now today, I am getting news on WhatsApp about locusts having entered Bandra, right? And we have locust problems now. One positive thing we had in the economy was agriculture, but now agriculture is getting affected by, suddenly out of the blue comes this locust shock. or you have a super cyclone in Bengal and East India where the entire paddy crop has been wasted. So we are literally getting pummeled. There's a pandemic. There are all these absolutely unheard of shocks that, I mean, unheard of in the sense that, it's not really something that was expected. So it's a very, very unfortunate time in the economy. And therefore, to think in terms of recovery, I think one has to be extremely optimistic. I am not. I think I'm more a realist. It's a very, very long time to even come to a stable macro situation. And if there is stability in terms of low volatility in the macro indicators and the financial indicators, I'm happy.
Please
So
go
I
ahead.
just quickly add to that. In between, I said it's a very dark story. Things aren't looking great, but I'm optimistic. Call me naive, but I'm optimistic. And I'll tell you what goes behind this, okay? I think solutions exist. And both Rajeshri and I kind of listed out what could happen, cleaning up the financial system, getting jobs and output, structural reform, all of that. The solutions exist. I think we will emerge at policy crossroads. We could go into the 1970s type populism and close the economy
Absolutely.
and now kind of stuff. That would be a disaster in my view. I'm hoping and praying we don't go there. I'm more hoping that we treat this as a springboard into 1991 type structural reforms, which gets us jobs, output, a clean financial sector, etc. So here is what I'm hoping for. I think in a crisis like in 1991, we did pivot from what were really dark, gloomy days where we were shipping out gold to UK, Bank of England, to use that opportunity to pivot towards growth. Okay, so I think solutions exist. Even though we will feel like we are in the dumps, I think it would be foolish to become absolutely down in the dumps and say kuch nahi hone wala hai. But here is what we need. One, we've got to face up to the truth. For too long, we've been playing around with the truth, whether it is NPA levels, whether it is a fiscal deficit. We love to fool ourselves. We love to give very nice, colorful picture in the face up to the bloody truth. The starting point to doing the right thing is to agree to what the current situation is. Don't sugarcoat it. You can't sugarcoat the situation. Once you've agreed what the truth is, I tell you the solutions fall in place. There is nothing that lots of good committees have come out with lots of good recommendations on how to solve all the problems of the country. Once you've acknowledged the truth, once you have conviction, and once you demonstrate execution, there is no reason why India cannot claim its rightful place in the economics of the world. We deserve to be much better than where we are right now. I think we'll get there. I hope and pray this crisis pivots us towards that.
Thank you, Anand. Thank you, Rajeshwari, for such a wonderful, insightful discussion and a lot of optimism along with the reality. So thanks a lot for your time. And I think we really, all of us as a group, got a lot more than we expected. Thanks a lot. I would like to thank NSE and Almas for making this whole webinar series happen with and continuing the conference intellect, thought, and thought leadership. I'd like to thank Maulik, especially in addition to the Almas and NSE teams, and Vijay Chand for supporting us on the social media front and being through us all. And look forward to the next edition from NSE and Almas and for some more insightful topics. Until then, thank you very much for attending and goodbye.